What's up everyone? Today I'll be talking about 6 large cap stocks that I've bought into, keeping the Federal Reserve rate cuts in mind. Let's get going. First, ABFRL. It manages some of the most popular clothing brands in India, and while it is still not technically profitable, that is mostly due to extremely high depreciation costs. With the company now fast diversifying into an e-commerce model with respectable names like The Collective and partnering with giants like Myntra and Flipkart, it is only a matter of time before the depreciation cost falls while the sales continue to rise in India where consumption is continuously growing. Second, Asian Paint. Now, the company's stock has suffered ever since Grasim announced its intention to foray into the paints business. While Grasim is indeed a giant and can make for formidable competition, Asian Paint's moat is just too strong for a new firm to break it down, especially with a recession on the horizon. It is also trading below its historical average PE when real estate, particularly new home sales, have been at record highs. It is highly unlikely that Grasim will be able to kickstart its business in time to be able to profit from this cycle. Third, Bajaj Finance. Trading at historically low valuations, Bajaj Finance has been victim to the RBI's very, albeit wise, strategies to keep India's credit situation in check. Regardless, it manages the largest NBFC portfolio in the country, and I don't believe any of us think that the company is going out of business anytime soon. In fact, the rate cuts should bode well for the firm since their cost of capital would come down, while the rates at which they have already offered loans over the last 2 years would stay fixed for the duration of the loan's tenure. As a high beta stock, Bajaj Finance is a must-have for double-digit returns in the short term. Fourth, Tech Mahindra. There is a direct link between technology stocks and central bank interest rates. Now, lower rates naturally mean more growth, which are obviously more beneficial for technology companies, at the same time by a formula that calculates future value for company and is very commonly used by investment firms. Low interest rates naturally mean higher current valuations. If you know what this means, great. If you don't and are good at math, you can Google future value and understand it. But honestly, it is not necessary. All you need to know is that as rates go down, the valuations, the price to earning multiples that we can give to companies increases. And that benefits growth stocks, of which technology stocks are a part, the most. Fifth, Indus Towers. This company was silently privatized by Bharti Airtel and since then has been cleaning up its books. The biggest overhang on the firm, Vodafone Idea's debt, is also showing signs of resolution. Something similar had happened in Tata Communications a few years back, and we all know how it has performed. An SIP stock to be kept for the next 3 to 6 months. Sixth, Divi's Lab, a true irreplaceable. Divi's Lab has it all: a good management, a strong moat, and an export-focused business that should benefit from this government's policies. Pharma as a sector can add a lot to India's GDP, and Divi's Lab is central to it. It has simply been victim to high raw material costs followed by low global demand for its products. With the Fed cutting rates and geopolitical tensions finally easing, Divi's should see a resurgence, and if history is anything to go by, it will be fast. And there you have it, my favorites. But please remember, I am not an investment advisor, so please do your own due diligence before investing. Until next time.